Thank you very much. I think it's very interesting in terms of the whole RDR space. As we look at the market and talk to a lot of people, we see a lot of companies, while focusing on being compliant with RDR, not making terribly many sort of bold moves in terms of how they're going to position themselves in post-RDR, allegedly because of the uncertainty of what the post-RDR environment will look like. And I think it's quite interesting in terms of hearing the previous two speakers and seeing other commentators. I actually think there's more degree of certainty in terms of what the likely outcome is than people are actually making actions to take advantage of what the future environment is like. So some of the stuff I will say will support the speakers. Others, where necessary, I'll try and challenge you just so we can get a debate going. In terms of RDR, in terms of, we think that there's the impact on the marketplace is going to be different according to segment. If you think about this chart here, which is essentially, what's the consumer's financial wealth and to the extent that the approach will likely to be intermediated or not, the biggest impact of RDR will be in this sort of red box here, which is sort of heartland IFA territory. And some of the other speakers have already gone through some of these elements in terms of the squeeze in the number of advisors, the move towards being upmarket, the importance of platform. I think particularly here, the new ways of competing in terms of a lot of, particularly the manufacturers, have in the past focused on using commission as a weapon to get shelf space with the advisors. Clearly that goes away. And obviously, if somebody is better at service or products, then that can give them an advantage in terms of shelf space. But I think there are a lot of, in the manufacturing space, undifferentiated competitors there who previously were getting business with commission, and that clearly will go away. So there will be a big change in that sort of red space. In the sort of amber or yellow space there, I think the key thing there is around the advice gap. Survey's different, but typically, going to cost £600 to £700 to provide advice to a sort of mass market consumer. Most surveys say people will only spend £100 to £200 on paying for that. So obviously, that advice cannot be provided by traditional methods. And so far, there's a real question of, will there be alternative methods of advice growing up to do that? So obviously one is direct consumer. We'll talk about that, and some of the speakers have talked about already. A lot of credence is being given potentially in terms of the workplace, in terms of can you use the fact that you've got a whole mass of people to distribute and provide advice in the workplace. And obviously there's been a lot of talk about streamlined advice, where I think so far it's been a bit of a sort of circle without a solution, where a number of the providers and other manufacturers have come up with potentially their views on streamlined advice and just have not felt confident that the regulator will be satisfied with that approach, or 5 years down the line, the ombudsman or somebody else may say, well, you really should have done something different in terms of that streamlined advice. There is, in terms of, definitely going to be an advice gap there, and I don't think there is necessarily a specific solution. We'll talk about what those might be. And then finally, in the sort of upper end of the market, I think initially people thought there was going to be sort of fairly limited impact in terms of the sort of high net worth upper end of mass affluent, and because already they had a economic model that was consistent with RDR. But we've actually seen there's been more change than probably people appreciate there, either because a lot of these institutions are part of global organizations, and you have the coordination problems of you've got RDR in the UK and not elsewhere, and also there's been this heavy dependence on alternatives and structured products and how that fits in with the RDR environment. So in fact, so all these three segments are affected in a different way from each other. In terms of picking up in again, to talk about in terms of the margins here, And if you think about it, there's basically three blocks. There's the investment management, the product, and the distribution. And as we saw beforehand, anything depending on whether it's an investment product or it's a tax wrap product, you're talking about 150 to 200 basis points the consumer is ending up paying. I think in terms of where we see the squeeze coming, we think across this value chain, there's probably going to be a 50 basis point, half percent squeeze. Across this, we think it's going to come mainly in two areas. One is in terms of the investment management area, not necessarily in terms of the active management, the actual fees hugely being squeezed there, but it'll be the shift in mix in terms of a big shift towards passive and ETFs. So you'll get going towards that 10 basis points. You probably won't reach 10 basis points, but going towards that 10 basis points as opposed to the 75. And the other squeeze we think will come in the sort of product administration, which is typically sort of the platform, this 30 to 50 basis points. I think it's interesting in terms of the wrap platforms, which are obviously beyond the supermarkets. When I was seeing people's business cases for either entering or the profitability of those wrap type platforms, probably 2 years ago, people were looking at 55 to 60 basis points. Now people are looking at around about 25. So already you're beginning to see quite a squeeze there. So I think you'll see those are the two areas of squeeze. You'll get some creativity and innovation around this whole investment assembly in terms of packaged solutions, and which will potentially offer differentiation. It's probably unlikely in terms of you're going to get much around the whole tax wrapper. That's already a fairly commodity type activity. And then in terms of advice, clearly it's going to be, advisors who have got a clear proposition value added to their end customer, then they're going to be able to get, more than 50 basis points, maybe even up to 100, while others who are basically product floggers are going to struggle even to get that 50 basis points. I think it's interesting when you talk to advisors, particularly in the sort of affluent part of the market. I think the advantage RDR has forced them to think about what their value add is, consumers. And when they've really been able to genuinely say there is some value added in terms of the activities they provide, then actually they've been able to persuade consumers that these type of charges in terms of the advice actually make sense. In terms of then what are these sort of opportunities and the winners and losers coming out of that? So we talked about the changing financial dynamics, about the margin squeeze likely to lead to either a scale play or a sort of differentiation niche play. One of the issues obviously is that why the affluent have the money, as some of the other speakers showed, there's going to be more players in that affluent market, which makes it more competitive. The economics will be helped by the fact that the degree of churning will probably go down because you won't have commission causing people to churn, but you've still got this advice gap issue. So I think in terms of that, we think there are going to be 5 opportunities here. There's around direct-to-consumer, a more focused approach to how people deal with IFAs, the workplace, platforms, investment solutions, and I'll talk about each of those. And obviously, underlying that is the strategic choices people have to make around, which channels are really is it going to be multi-channel, focus on one channel versus another? Is the proposition going to be, is it purely around cost, or what additional things are going to be offered? The breadth of products, some people are going waterfront, others are going a more narrow selection. And then generally, where in the value chain are you going to focus on one area like investments or have a broader activity across the value chain? So let's talk about direct consumer. Direct consumer obviously has been talked about in terms of, for many years, in terms of potential in the financial services space. It is growing, as Ian's charts showed, in terms of the banking industry particularly. There's really sort of 2 things that will be to sort of overcome here in terms of, one, in terms of the on the top right-hand side here, in terms of consumers who currently have an advisor and in the future will not have an advisor either because that advisor has exited the business or alternatively, the consumer is not prepared to pay for what the advisor is charging. And that's all around educating and helping the consumer understand they really can do it directly. They don't necessarily need the advisor. And then on the sort of bottom end here is the people who have already start doing some direct consumer, where they're a Hargreaves client or something like that, in terms of convincing them, that you can more effectively serve them and they can expand the range of the type of activities they're doing direct consumer. So we think direct consumer, clearly in terms of what will be important in the direct consumer will be the consumer brand name, as talked about previously. It will be scale in terms of the infrastructure to provide this in an economic basis, but also in terms of the importance of marketing. Consumer engagement will increase enormously, and I think people who have typically been distributing through advisors will find that quite a challenge in terms of really getting more sort of customer centricity, understanding how to engage consumers, data analytics to understand those consumers better, flexibility in terms of the offerings, having some modular component parts that you can then flexibly put together in terms of offering a more tailored solution without necessarily having the bespoke cost of that. So that's direct consumer. We're going to see in terms of there'll be greater segmentation in the intermediary market. If you think today, obviously, in terms of if you're dealing with distributors today, a lot of particularly the IFAs, why the individual IFA can have a nice business. IFA firms have had problems in terms of profitability. Most of them lose money, and most of them don't necessarily have control over